Hi there, I'm Gugu, the host of Kaya Biz here on Kaya 959. Now, if it's your first time joining us, where have you been? This is where we have the opportunity to share a few insights with you into some of the key economic and business themes that really impact not only our pockets, but our lives as South Africans. And today we're going to focus on the South African Reserve Bank. If you have some money around you, a coin, maybe a note, pull it out, feel it, touch it, examine it, and pay close attention to the detail that's on it, because that money is essentially printed by the South African Reserve Bank. But that's just one element of what they do. Perhaps let's focus on the overall structure and organization of the South African Reserve Bank. Well, the South African Reserve Bank, as the name suggests, is the central bank of South Africa. Part of their primary responsibility is not only to maintain the safety and the soundness of our payment system, but they also regulate banks as well as their operations and licensing. They take care of monitoring the MPC, which is our Monetary Policy Committee, through an evaluation of the economic climate and monitoring inflation and how they respond through interest rates, which essentially helps us protect the rand that we have in our pocket in order to go further in terms of payments. Now, that's a wide array of what the South African Reserve Bank does, including printing, payment, distribution, and even destroying some of our currency. But that's because they essentially have the mandate to print, distribute much of this money that all of us make use of through various infrastructure institutions such as ATMs, banks, and even the retail stores that we interact with. But let's take two steps back slightly when we talk about the SARB. And one element that I really want to zone into is the MPC. This is essentially the Monetary Policy Committee. And whenever you hear about the South African Reserve Bank, every second month, this is most likely where we'll hear a message from the MPC giving us some clarity on how interest rates will either be adjusted, monitored, or reevaluated in order to meet the current economic climate. Now, that's quite important because if you have ever gone into a financial services institution and taken out a loan, you'd know that coupled with taking out credit is having to pay it back with some interest. And that interest is essentially a rate which is calculated, configured, and evaluated by the South African Reserve Bank. Now, that's primarily the prime interest rate, the amount that the loan, or interest rate rather, that the banks need to charge you for lending you money. But there's also another rate that's attached to it, which is the repo rate. The money and the loan and the interest, essentially, that banks need to pay back to the South African Reserve Bank after taking out money from them. But let's unpack why this is important and why every second month, essentially, this meeting is held. Well, we know that in the global climate of things, there's an interesting relationship when we go back to Economics 101, a relationship between inflation and interest rates. And the job of the MPC and many other central banks across the globe is to make sure that they respond appropriately with the right interest rates to meet the current inflationary environment. So let's put it this way. Inflation is essentially that Pac-Man that eats away at the growth and earning potential or money that you have. It's the same reason why a loaf of bread was 5 Rand well over a few years ago, and now that it's over 15 Rand for a loaf of bread in the current times that we're living in South Africa. That's because inflation has essentially eaten away at the value of this money. And this essentially does speak to purchasing power parity. It's the same reason why we see the Rand trading differently or at different rates in comparison to the US dollar. But essentially, the MPC responds by adjusting interest rates, and they take into account a number of elements. Economic growth, what's happening with inflation, and inflation is key because this has to be within their targeted mandate of between 3 to 6%. Now, in South Africa, we have been fairly safe where inflation has been around 4.6 to 4.7% in recent months. And whilst the September print will be released, many of us will be able to analyze these numbers in retrospect in South Africa. But let me put it to you this way. At the time of recording this video, the September MPC interest rate announcement had yet to be made. But by the time you watch this, that announcement will be made already. But to give you some context, essentially the relationship that we're looking for in terms of clarity as to how the MPC affects our pockets is this. Currently, interest rates are at an all-time low in South Africa. 7%, that's the prime lending rate, and 3.5%, which is the repo rate. Again, going back to how the banks actually lend money. And this is quite substantial because since the impact of the pandemic and the subsequent lockdowns, we saw the SARB and the MPC responding by cutting interest rates, essentially trying to make it easier for South Africans to spend. those who are highly indebted to pay off their debt, and those who actually want to access more debt to go out and be able to afford it at a slightly cheaper interest rate. Many economists have actually said that this is likely where we're going to see interest rates stay for a while, but we're well aware that at some point interest rates will have to increase in response to rising inflation. And inflation itself has been a moving target, right? Because during the lockdown, this is where we saw inflation come down significantly because there was no trade. We couldn't shop, we couldn't travel, we couldn't move our goods in and out of our borders, and we saw minimal economic activity because everyone was on a hard lockdown. Given that the world and the country has slowly begun to reopen, and their comparisons of economic activity from 2021, where the world is reopening, versus 2020, where there was a substantial lockdown across the globe, these numbers are changing drastically. And as a result, this is where we rely on central banks like the local SARB and the MPC to respond appropriately with the right economic tools. So let's put it to you this way, as we conclude. What you do need to look out for in future MPC meetings that take place in South Africa and across the globe is essentially these two things. For us as consumers, we likely have debt or we're likely to be savers. If you happen to be a saver, this is where low interest rates might work against you, because essentially it means that the money that you have saved up will only be able to grow at a minimal rate. In South Africa, that's at 7%, unless there's also some kind of added extra that the financial service institution you're saving with adds to your saving opportunity. If you're someone who's indebted, though, this means that the money that you owe to the bank and the substantial interest that you need to pay back is significantly lower. And that's why we've seen a number of South Africans look to take out more credit, particularly when it comes to vehicle financing, home loans, and the likes, because it's a little bit cheaper in this current environment to be able to access credit. But if there's one thing that you do need to be mindful of as a South African, especially a consumer, when monitoring interest rates, is to know that they change. Nothing stays the same forever or indefinitely. And all of this is related to cycles. So if you are one of those South Africans who's taken out the opportunity to increase their level of debt because of these lower interest rates, do be mindful of making sure that you have a bit of a buffer in place, that once we do begin our rate hiking cycle, that you will be able to continue to afford the additional cost and interest on your debt to make sure that you cover your financial responsibilities.